Welcome to the Rask Network. What you're about to hear and see is limited to general financial information only, or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Mitchell Sneddon, how you going, mate?
Good, Owen. How you doing?
Good. That I feel like that pre-roll video might have come through a bit pixelated for folks. So welcome to today's monthly update for Rask Invest. But mate, how are you going?
I'm good, Owen. And just in case that video was a bit, because it was a bit stunted or jerky at my end. So in case anyone did miss it, what that video was telling you was that anything we do or say during this webinar is general advice only. Please see a financial advisor if you require anything personalized.
Absolutely. And one of the things that we do every month is we front up to you, our investors, and also if you're a Rask Core member, and we tell you what we've done with the portfolio, we share some insights, we talk about performance. And whenever you talk about performance in finance, it comes with the usual disclaimer as well, which is that past performance is not necessarily indicative of future performance. And that's really important to understand, particularly because with us, with Rask Invest, we've only been going for a few months, and we're here to invest for 10 or 20 or 30 years into the future, not necessarily for the next 10 months or 10 days. So we really want to kind of like augment your focus to the long term. So just in the meantime, we're always going to repeat that disclaimer, Mitch. But what have we got for folks today?
Well, we were just actually saying July was a fairly boring month, to be fair, when it comes to portfolios and portfolio movement. All the action that's probably front of mind came from those the big movements in the US, which actually took place in August. So if you stay tuned for the August update. But we did see, of course, a bit of a pullback, a pretty strong reaction in the US, which of course affected our IVV and IHVV, our S&P 500 ETFs. A little bit of a flow-on effect to the ASX 300 ETF that we have with the Vanguard portfolio. Mm-hmm. But as we were just saying off air, we've actually seen that brief volatility be actually recovered already. We're pretty much back to square, essentially where we left off at the end of July. So that short-term volatility didn't build into any considerable momentum. Had a couple of down days, but now we've already gone on to recover those.
Yeah, I love I just love the idea of building a sensibly diversified core portfolio, because even when that volatility struck earlier this month, like historically, when I really get into the weeds in quarterly earnings, which kind of coincided with that big sell-off earlier this month, I think there's a really interesting thing that happens when you abstract away from the daily noise. You just become so much more sensible with the way you invest, and you sleep better and all these types of things. But what was really interesting when we looked at the portfolio for that probably week block was that the bond ETFs in our portfolio continued to go up at the same time that stocks were being pretty volatile. So it's just beautiful diversification in action. And we haven't probably seen that type of true diversification for at least a couple of years, where the power of those two core building blocks were working as exactly they should be. So that was really, really great to see. And, fast forward to now where we've kind of made up ground, and it's all happy days, mate. So, here's the agenda for today. If anyone wants to ask any questions, you can do that now via the chat function. I can see Matthew, Financial Freedom, Troy.
There's quite a good little comment there from Matthew. He saying took advantage and bought a week early during the dip. Not a lot, but that's the beginning. One thing I did see from a Rask Invest side of things, I did see that that Monday and that Tuesday that coincided in early August when we did see that pullback. I saw the daily inflows into existing accounts with Rask Invest substantially increase. So I know we were a lot of the Rask Invest investors that I'd spoken to with over the last probably three and a half months, they were all sitting with a nice substantial amount of cash at hand. And they'd started off with a smaller amount than what they had intended to invest with, and were keen to see some pullbacks. I don't think it was as big a one as they all kind of hoped for, but I know that some did take advantage, and I anecdotally saw a significant increase in contributions on those 2 days.
It's really reassuring, isn't it? I mean, most funds management businesses deal with the complete opposite of people trying to sell out at the worst.
Yeah, you really in a standard funds management business, you really do actually fear those volatile days. What you fear a lot actually is not the volatile days themselves. This is quite interesting for insight into maybe some investor psychology as well. It's not the people whose portfolios have say they've come in. So imagine if you opened your account the day before, as some people probably would have, and then bang, your first experience is a steep decline. That's not when you're worried about outflows as a fund manager, because those people have anchored to the entry point that they came in at. The point that you worry about for those investors are when they actually get their portfolio back to square. So
why? Because they pull out. Because they think, well,
because they've got the loss back, and they said, rightio. So they think, bang, immediately if they've had a negative experience, they immediately think they've made the wrong decision. So they can't separate that the outcome from the decision-making process of, hey, I'm going to have a really broad diversified portfolio. I'm going to dollar cost average, going to do X, Y, and Z. And just if they experience a decline steeply immediately, it's like, oh, I've made a mistake.
It's kind of like people when they go to the casino, right? Like they start to lose money, and then they're like, well, I'll just put more down just to get back to what I came in with, and then they just keep losing money.
Yeah,
which in this instance, it might hopefully it is the opposite.
Yeah. So it's historically, we're talking historically. My experience was definitely that those people who did have that negative experience straight away, once they make that back, there can be a tendency to say, rightio, I'm back to square, out I pop. Whereas, yeah.
Sorry, Tywin just asked a question, which I think we did this last month, but I would be interested to know. Sorry to cut you off, Mitch. I didn't mean to be rude. But I was going to ask you the same question.
Yeah,
it might be relevant for people that are watching to actually know the average amount that people invest with us. And keep in mind, it is really early days, everyone. So typically we will expect this to expand drastically over the next 3 to 5 years as people get more comfortable with us. But do you have those just off the top of your head?
I don't. If you can pad for 2 minutes.
Yeah, I'm pretty sure. So I'm pretty sure I can fill you in.
I've got them right now, actually.
Okay,
so
yeah, I'm pretty sure I know.
Our average balance currently is just under 57,000.
Yeah, and I think the monthly regular contribution plan is about 2,100.
The average, the median is 800 for someone contributing on the regular monthly contribution plan, and the average is $1,208.32. Yeah.
Yep. Okay, so that gives you some context around it, Tywin. And obviously, the data is skewed depending on if it's an account holder, because remember, people can have multiple portfolios within an account, so that tends to skew. But we have balances way up the spectrum, and we also have a lot of people that have kids accounts with us, and that's why I think I've got it. I just show the disclaimer a second time, just so you know. There's also a product disclosure statement for Rask Invest and a TMD that's available at the invest.rask.com.au website. So everyone would have to tick the boxes for those before investing with us, but those are there, and we should always reference those. So it's Mitchell and I joining us today. Mitchell, head of funds management, and myself. We can come back to that, but yeah. So this was the thing that we're working on in the background over the next few months is how do we facilitate more children's accounts for parents and grandparents in particular. How do we facilitate that? So that's one thing that we are working on, and something that is probably the most front of mind for us right now. So I just want to bring that up. So that can skew the numbers, Owen. in terms of how people invest with us. Is that fair to say, Mitch?
Yeah, absolutely. We do have a lot of people just starting out, and even though our website does state that our minimum investment is $20,000, we can technically take down to 10,000, and so Matthew needs 4 of those accounts. We'll sort you out, Matthew. No problems. So we can take down to $10,000, but something that Owen and I are actively working on, and it's been requested by our community, is a more achievable entry point for children, and so we're working on something that's very suitable for incredibly long-term investing.
Yeah. Troy and Matthew both referred to this, so I'll just quickly tackle it now. Is VHY going to be in the 70-30 portfolio long term? So this is the Martian portfolio. Why don't we actually just bring up the numbers for the month, which we've got here. So in the first column, it shows you the weight of the position in the portfolio. So this is what fancy speak consultants would call like attribution or contribution to portfolio returns. So you can see the monthly return at the bottom. You can see that there for each of the different portfolios. You can see the weight of the position, and you can see its contribution to the overall return. So I hope that makes sense. Now, the one that you're referring to is the Martian portfolio, which is our 70-30 strategy. Now you can see there's a small position in VHY here. Now, over the long term, VHY has behaved very similar. So VHY is the high dividend yield ETF. In my opinion, it's the strongest, it's the best dividend ETF in Australia. And it's really similar in the way it behaves to the VAS ETF. So even though, yes, it has a yield focus, in total return terms, it's actually very similar. And what the difference basically boils down to over time is effectively the environment. Like say, if you take like a 5-year snapshot today, you might find that VHY slightly outperformed because inflation was low, dividend stocks did pretty well. But if you go back 5 years, you might have found that VAS was slightly better. So in terms of the overall contribution and what it actually adds to the portfolio, it's not that different. But the key reason that we include it here is it's kind of like a starting position. If we do want to allocate more to it in the future, we can do that. And you'll notice that it also creates a bridge between the 3 different strategies. You can see the similarity in the building blocks left to right. One thing to note from these tables, ladies and gents, is that we have exited the position in FEMX. It's just that this is the July data. So in August, we're in August now. That's changed, just so we're all aware. Mitch, we've already covered the volatility, bit of inflation, people getting a bit more optimistic. Maybe just exercise caution would be the feedback there.
Always.
Yeah.
Always.
Have you? One of the things that I like to do, and I'm sure it is useful for everyone else watching, is you speak to dozens and dozens and dozens of investors. What, if anything, over the past month has really jumped out at you?
I think the common trend at the moment in conversations I'm having, of course, I'm having conversations predominantly with people who are looking to get invested, or they're looking to get invested within the next, 5, 6, 7 months. So they're starting to get their ducks in a row. And there has been a common trend coming through on people who are actually selling their investment property. People selling the investment property and looking to not actually purchase another investment property, but to put those funds to work in an investment portfolio. And they're doing that for a number of reasons. They're doing it for the fact that land tax has been introduced. Property is becoming a bit of a political football. And so there's increasing uncertainty building around that, especially younger people. When I say younger cohorts, I mean people in, say, their 40s who have previously bought an investment property and are now deciding to move on from that. One thing that comes up quite regularly is the fact that their ETFs will not call them at 10 p.m. In the evening to request a plumber. So the land tax, the political landscape, dealing with real estate agents, dealing with tenants, I'm finding a lot of people who who came to property as their first foray into investing, and now actually stepping back from that and looking at a diversified portfolio. And they're talking to us, which is fantastic.
Yeah, that's a great point. There was a question CL's Travel wrote in a couple minutes ago now. Sorry to just get to this now. If you have your investing strategy that you don't sway away from, hypothetically, would it be wise to keep some cash in a savings account or similar to a volatile for a volatile day? I'm going to show you something CL's Travel. So in our slides here, you would have noticed that in our portfolios, we have this line at the bottom called cash. Just make no mistake, the AAA up the top here, this ETF, is basically, it's just an ETF that invests in term deposits. So this AAA plus the cash amount is actually our cash balance in the strategies. It's just that we minimize the amount of actual cash that's sitting in our investors' bank accounts because it doesn't pay interest. So we don't, just like, because we buy everything on HIN, just like a normal, like secure brokering platform, as opposed to a managed fund, we try and minimize the amount of cash. We just have enough there for like people that withdraw or have income streams and that sort of stuff. So in terms of our portfolio makeup, we are sitting in some cash the whole time. And fortunately, we're very happy to do that because the cash is paying us very good interest at the moment. So our investors would want us to do that. Now, in a different scenario, there may be a better way to allocate cash. And one of the things that we wrote about this month, I should get rid of this extra dot point here, was this. I did share this in my weekly newsletter to investors. So everyone who's invested with us and everyone who's a member, and anyone actually, just gets our weekly email for free. But in there, I talked about the benefit of using an offset account. An offset account can get you interest above and beyond what you can from a term deposit or a cash ETF, even the kind of spicier ones, because you don't pay tax on the interest that you save on a mortgage. So if anyone is out there with a mortgage like myself, it does make sense to keep some cash in an offset account, but they should also know that our portfolios are diversified and do have cash and do have bonds, because if we see another, like an actual meaningful market correction, not like the one that we had a couple of weeks ago, but an actual pullback, what we would expect to see is the bond side of our portfolio and the cash side of our portfolio very resilient, and then we would make the decision to rebalance in. So for most of our investors, I would say don't overcomplicate it. You're probably better off just having a diversified portfolio all the time and just keep investing in it rather than try and time with cash in a savings account or something like that. It's a very common question that we get, hence why we wrote the article about it. We're diversified, and the key reason that most people don't invest a lot of cash straight away is because they've been taught that there's only two things that really matter: the stock market return and their cash. But when you have a diversified portfolio like these ones are, in reality, that portfolio is an all-weather portfolio. So even if the market did crash tomorrow, as Mitchell was suggesting, there are certain elements of that portfolio which will not crash because they're not tied to the stock market. And so depending on how an investor actually builds their portfolio, the answer to that question is very different. But for us, we're diversified, so we would expect people to just keep investing regularly is probably the answer. I hope that makes sense, Mitch.
And yes, and just a note on these portfolios as well, we do need to treat these as if someone would just invest, say, even the minimum investment, and never top up, never contribute. So the cash component of the portfolios certainly acts as a buffer in a declining market, but then also gives us an attacking mechanism to add to our growth assets when we've had a significant pullback. We can't, or we don't, rely just purely on potentially investors topping up their accounts at those times. So this gives us that ability to do that and earn some nice interest on them at the same time.
Yeah, absolutely.
Speaking of that topping up, Owen, just came to me as well, actually. Off our last live update that we did, you did flag that a potential diversifier. Yeah, you're highlighting it now. Adding some ASX 20 exposure and getting more exposure to that the middle of the ASX 200 into the portfolios. We were talking about that in our last update. And then post, I actually had a conversation with a lot of our Rask Invest investors who said, because we're adding a new position and just hypothetically, let's say it's 10% of the portfolio, instead of selling, say in Jupiter, instead of selling down 10% of that 40% position to 30, they would like to add further cash to bring that position in. And because we flagged that in our last update, it's not a move that we have done, but it's something that we're sitting with the investment committee on. Because we flagged that, our investors got in touch with us and said, hey, this is how I'd like to do it. I actually reached out to our trader and said, would it be possible that when we do come to do that, if we do come to do that, could we say place a halt on the portfolios for say a couple of days and say to our investors, if you were to add any funds that you add between this period, initially will go to making up this new position in the portfolio. And every investor that I spoke, and the answer was yes, we could do that. And every investor I spoke to afterwards really liked that ability. Now, so that all came from us flagging that that's a potential and that we're discussing it. And our own investors are giving us some great ideas about how they want to manage their portfolios.
Yeah, thanks, Mitch. I'll bring this up again, and I'll just circle around why this is important. So we've recognized that we probably want a little bit more diversification in the Jupiter strategy. There are two ways that anyone could diversify an existing portfolio. You can sell out and then use the proceeds to purchase a new position or multiple positions. What we're suggesting is, because we're so early in our journey and because of the unique structure of our platform versus like a managed fund, which we'll talk about in a minute, what we can say to you, and some of our investors have been blown away by this, we actually tell you in advance what we're thinking of doing. So like Mitch said, we can get your feedback because we want to hear from you. We want to build the best investment solution the country has seen. And how do we do that? Well, we have to hear from the people that invest in it. And so what we can do, instead of selling this part of this position, is we might be able to just create a new position and tell people with enough notice, hey, we're going to put this new position in here. Do you want to invest money now just to go into that thing? Then that way there's no taxable component being crystallized from the existing position. That's what we can do. And we can say, hey, we're going to pause money coming in for the next and automatically invested for the next 7 days. And anyone that puts money in this 7-day window, we're going to use that to only place one trade rather than a sell and then a purchase and cause you tax. We're going to try and do this as tax efficiently as possible and as cost efficiently as possible. And we tell you in advance. If you notice, like anytime you see a fund manager go on and talk about a stock or whatever, they go on like one of your favorite investment websites, chances are they've already got a full position. They won't tell you what they're going to do in advance. And then when they do the recording and it goes to air, then they start selling as you start buying. It's a very conflicted type of thing, and there's no rules against that. But we don't have to worry about any of that mumbo jumbo or that confliction. We can just literally tell you what we're going to do and say, what's the best thing for you? Do you want to participate in this or not?
And I would point out that it's the Jupiter, of course, is our long-term portfolio, 10 plus years. And so that's the portfolio most people are dollar cost averaging into. So they naturally are topping up their positions on a relatively regular basis. So when that time does come, we'll be flagging that to our investors well and truly in advance. And so they can make an informed decision about what they want to do. Now, of course, if people are not adding to that portfolio, that's absolutely fine. What would take place if and when this does happen is just the stock standard trimming a bit of the VAS and bringing in the new position.
Yeah. So that's something that we will let you know about. We don't. The thing about the way we invest is we don't have to rush into anything. Sure, we have rules around if the stock market crashes, we would rebalance, but we don't have to rush into anything. Our true power, Morgan Housel's famous headline, which I always quote, 99% of long-term investing is doing nothing. So that's the reality of how we invest is are out here thinking a lot and not acting a lot, because those actions will cost you, in brokerage fees or in taxable gains. So we just want to be really patient and methodical about how we build this over the long term. Jason, you've said, I think this would be a really good thing to bring in for investors and would look at utilizing this if it was an option. Thanks for the feedback, Justin. Really appreciate it. Some notable updates from this month. So Pete, who's our macro consultant and also the co-host of the Property Podcast, has a great article about the interest rate dam is bursting. If you're a fan of the Property Podcast and Pete's insights, I would read this, then listen to his episode on inflation, because he wrote this and then we got the big inflation number from the RBA, well, basically RBA commentary. So that's there. We also walked you through why we sold FEMX. People were asking, can you write this up, not just tell us about it? So we wrote it up, explain what multi-factor funds are, why we think they're appropriate in places like emerging markets, and why we switched to this. So that's all available both inside Rask Core, but also inside Rask Invest. Every month, you should know that every month on our Australian Finance Podcast, we do a broad market update. So we talk about some of the ETFs that we have in our portfolios, like we're doing today. But it's more high level. So we talk about other ETFs. We talk about things like gold. We talk about cryptocurrencies. We talk about what's happening in the economy. It's more broad than what Mitch and I talk about every month. So you can just tune in, just subscribe and wait for that market update to come. And typically it ties in with one educational piece. So there's like an educational piece plus a broad market update. That's every month in the Australian Finance Podcast. We've already talked about the introduction of the small/mid-cap bias. We did mention briefly, there is a wonderful article and a community post about paying off your mortgage or investing. It's a question we get a lot. The bottom line is you should probably do both, to be honest. It's one of those false choices in finance. Should you do this or should you do that? You can do both. And that would be probably the best practice in terms of your education, in terms of your habits and forming good investing habits, but also in terms of the long-term outcome, particularly if you have a growth investment, like a growth investment profile, because you might capture a lot of franking credits and tax credits that go into long-term compounding. So that's that there. But we did have some really interesting questions that are either sent in advance or we've kind of bundled up and put them together for you this month. So I'll just scroll down. And we're happy to talk through these one by one. In the meantime,
yeah, it looks like we've taken care of a couple of them already, Owen.
Yeah, so these two we've already done. Please send in your questions now. There's a lot of people in the chat, so just send in your questions if you have them for us. It could be about ETFs we hold or don't, or whatever the case, maybe just feedback. This one here, I might just double click on this lump sum investing. This is typically coming in the form of property investors who have sold out and they've got equity in their property. They've put aside some money for capital gains tax that they're going to share with the ATO, and the ATO is very thankful for your contribution. But then the other side of that is like, what do I do with the proceeds? And we're getting a lot of these questions. It might also come from like a business sale. It could come from many different things, to be honest. A lot of people have lump sums, inheritances, different amounts of money. And it probably relates to the next one in a way. But what most people tend to think about when they get into that situation is they've got a lump sum of money, and it typically goes one of two ways. It typically goes into a super fund, or it goes straight into an investment portfolio like, say, Rask Invest. Now, there are pros and cons to both of these things. Obviously, with super, you may be able to claim a tax deduction depending on your situation. You may be able to make a non-concessional contribution to super, and so on and so forth. But then there's also the con of it's a long time locked away, and you may not be able to utilize it in the way that you like. And I'm assuming someone has like an industry super fund like Aussie Super or Rest or Host Plus or something like that. The other option is to, if you're already investing with us, people might say, well, I'll just give it to you to manage. And then you can still, in effect, do the same type of investing you would inside super. You don't have the same tax rate, of course. It's in your name. You own the investments. But you have the flexibility of being able to withdraw it as income or as a capital lump sum in the future at a time of your choice. So there's more flexibility in that regard. And we're currently getting a lot of these questions come to us. And probably what I would say is that it really just depends on their long-term goals and the age of the investors that we deal with. A lot of the younger people are choosing to keep it outside of the super environment because they may have shorter term, like retire early goals. They might have, other goals that don't necessarily gel or align with being in super for such a long time. Mitch, is that a fair kind of overview of this?
Yeah, I think so. I mean, of course, the other one is they would like to pay off their mortgage, Rask Invest Super, and pay down any debt. But there is a middle ground. Once again, investing is not a either or kind of situation, as you were alluding to, Owen, before with the offset account. People could say invest outside of super and have a contribution plan, so they can work towards, of course, having that buffer. So when they retire, or decrease their level of activity at work, until they can actually access that super. So once they have that in mind, they can be contributing to the super, because of course, until the government interferes more and more and more, the tax benefits of superannuation are, of course, fantastic. But that is one fear actually that people I'm talking to definitely have. They're seeing the government get their hands more and more into superannuation, the rules changing, et cetera, et cetera. So hence why they're wanting a bit of a buffer outside of it.
Yeah, and so I say that we as a business are kind of agnostic to the type of super structure that you use, whether you use a self-managed super fund, an industry fund like Aussie Super as an example, or whether you use a retail fund like Colonial First State. That's called a retail fund. So there's three big pools of super. There's industry super funds, which are the ones that do the weird hand thing that you see on the TV. Then there's the retail funds, like the company named ones, like Commonwealth Bank Super, that type of thing, whatever they might be. And then there's the self-managed super fund community, who manage the pool of assets themselves. They might also have a retail or an industry fund to hold their insurance, but for their investing, it goes into an SMSF. So we can handle SMSFs. Obviously, if it goes into an industry fund, we can't. That goes to Australian Super. They deal with it. And people I know use those big super funds, and then basically just copy the ETFs that we have kind of picked through Rask Core or through Rask Invest, and they replicate it as best they think they want to in their super fund. You don't have to do that. Speak to your advisor. But when it comes to Rask Invest, what I'm seeing is that there are a lot of conversations nowadays, especially since the changes on property, but also the balance transfer cap that's come in. So the balance transfer cap is currently set at 1.9 million. And that might sound like a lot of money, and it is, and fantastic retirement, no doubt on that. But there's a lot of business owners or even younger people in their 30s, 40s, 50s that can see, through some pretty straightforward Excel modeling, that maybe in the future they might hit that really quickly as long as they're contributing through their employer's wage and these types of things. And so they're thinking, well, if they've got that in place now, what's going to change in 10 years or 20 years? And so what I'm seeing is a lot more people talk about family trusts, a lot more people talk about having investment companies, investing in a partner's name, these types of things. And that's why the Rask Invest platform handles family trusts. It handles all of those different structures because people know nowadays that there are other options other than just investing in your own name. So I just want to bring that up. One of the things that we've also been seeing in our community, Mitch, is we're big fans of people getting financial advice. Absolutely. Like super pro advice. Our community, everyone tells us that the Rask community is really independent in the sense of like everyone's really dialed in. They know what they want, but they still want second opinions. They still want to help their partner understand that, hey, I'm not just, making up this investing thing. Look, here's a professional, a trained professional who is talking our language. But one of the things that's come up, and we should probably talk about this, is a lot of people that get advice. A lot of people that get advice want to invest with us, but their financial advisor says they can't talk about it. So they can't talk about our investment service. Mitch, did you want to maybe just talk a little bit about that?
Yeah, certainly. So this comes actually from the dot point above as well. Who's generally speaking, I find that people who are starting out and they're buying a few ETFs, they've saved their $20,000 and start with Rask Invest, and they just are putting their savings in, etc. They're happy, they're fine, they've got very simple financial needs. it's the people who have gone and say sold that property or got a large inheritance or whatnot, and they sit back and go, before we make any decisions here, let's go off and see an advisor, which is great. You measure twice, cut once, so to speak. Just one thing, especially when people go through the Rask website and they get matched with a financial advisor, which I know is really, really common, because we've vetted all the advisors there and think they're fantastic. They, generally speaking, or 99% of the time, can't actually advise on the Rask Invest, because Rask Invest is brand new, and it doesn't. We haven't gone through the ratings process. Now, for people not in the industry, that means there's two core kind of research houses out there who put ratings, like recommendations, for it on managed investment products. And they'll provide you with a highly recommended or a recommended rating. That essentially gives a lot of these advice groups the green tick of approval to, hey, a third party's given this the green light. We can put it on our list of investments that we can discuss with our clients. And I don't know, 90% of the industry probably use that system, Owen. And because we haven't gone down that path, ratings are expensive to get. Generally, you need a few years as well of track record before you go down that path. So we've not done that. And that's, generally speaking, you go down the ratings path as well if you want to get onto the advisor lists. And the advisor, it's called an approved product list. So we've not gone down that path. Because we haven't gone down that path, generally speaking, an advisor out there can't actually say, yes, this Rask Invest portfolio is right for you, or this one's right, Jupiter, Terra, Martian, which one's right for you. So and we've actually spoken with our advice partners on this. They have said, if you've got your heart set on joining us here, as many, many people already have, what you can do is say to them, hey, guys, I really want to invest with Rask. I'm after a piece of advice on everything outside of that. And they say, okay, and they'll park. They'll segment that from their piece of advice that they're providing you.
So, yeah, that's great, Mitch. So basically, a lot of our community is going to get financial advice, but saying, hey, I want to invest with Rask. And the advisor turns to them and says, listen, I can't give you advice on that, but I can give you advice on these other things over here. And it's not always because the advisor wants to sell you something else. It's if you've seen The Big Short, the movie with Steve Carell, Ryan Gosling, the one how they're betting against the housing market in the US, you might remember a scene in there where Steve Carell goes to a ratings agency and says, hey, you need to change the rating on these junk bonds. It doesn't make sense that you would be giving them a highly recommended tick when they're clearly, the housing market's about to collapse. And the lady says, well, that's, in its summary, what she says is, no, we're Standard and Poor's. We've got a business to uphold. We've got to make money. And so the finance industry is basically built on this, where a financial advice firm doesn't want to take risk on something that's outside of what the insurer says is okay, or the ratings agency says okay, so then they can blame someone else if something goes wrong. And that's a cynical but accurate take of how it works. Now, with us, we don't obviously do that. We have licensed technology that's been in place for many, many years. It's a HIN-based model, whereas most of the managed funds are very different. That's the next question, Mitch, which I'm going to ask you to answer. So our product is quite different and quite unique, and that's why we have all the functionality that we have, but it's very new to a lot of groups. And I used to work for one of those rating agencies, by the way, and I speak very highly of them. They're great, but I used to work for one of them, and I know the way the sausage is made, and I got to admit, like, that's how it is made. And so for us, we're not on that list. So the best thing to do is speak to your advisor, but tell them if you are invested with us and you want to keep that, just tell them that. There's been a lot of confusion.
Yeah, or if you are strongly considering. I know a lot of people and maybe a lot of people actually on this live stream might be in this same situation. So many people actually come to me, and when we're having our conversations, this comes in as we're kind of like wrapping up. They'll say, you know what, I've done well. We had coffee with a couple not too long ago, Owen, and they refused to let you pay for the coffees.
Very lovely.
And because it was, they said you've provided us so much education with the free courses and the podcast over the years. And quite a few people actually say to me, by investing through us, that's their way of supporting the future growth of the Rask Group, and so the podcast can continue, the educational content can go on, et cetera, et cetera. So it's a wonderful way of thinking about it, and thinking about them actually giving back to the Rask community and to financial education in Australia as a whole. So I thought that was a really good benefit of investing that didn't actually come to me until we had coffee with this really great couple.
Yeah, that's something that seems to be popping up quite a bit. Yeah, and it comes through a lot in our questions and the live questions and instant feedback, even the community posts. Like, there's been one of the things about being a public-facing investment company and someone who actually fronts up every month, like as a team. We're open to criticism, we're open to feedback, and we're just generally just more honest and transparent because we have to be. Because if we're not, then you can just log into your dashboard and you can see all of the investments. You can see how everything is performed. There's no hiding it, right? Whereas if you go into a different structure, you can end up where you don't know exactly what you're invested in. There's no one to call. There's no one doing these live shows. Like, I've seen plenty of instances where professional investors just simply haven't responded to investors for months at a time because they're not legally obliged to, and they can just keep their head in the sand. Whereas we're out here trying to say a certain thing, and we're trying to support people in our community. We've actually got another strategy day tomorrow. But I remember when we did our last strategy day years and years and years ago at Phillip Island, we hired this beautiful place, and we got the whole team down there from interstate. And what we all kind of concluded, that Rask exists because we are able to speak the language of people that want professional investing, and we have monetizable professional products and services, and then we can use that to subsidize the stuff that we do for free. And years and years later, now people see that and see what we're trying to do, and that's one of the wonderful benefits. But anyway, of course, we'd say something like that. But mate, can you answer this question? This question did come through in advance. What's the difference between ETFs and managed funds, and how do I invest in managed/mutual funds? Well,
I'll just quickly take mutual funds. And mutual funds is the US kind of terminology for a managed fund. So in Australia, they're the same thing. Managed funds, mutual funds, same thing. ETFs and managed funds are actually very similar too in terms of structure. They're unit trusts. So your ownership or your investment is represented in units. You get given units when you buy into an ETF or a managed fund, and you redeem those units for cash on the way out. So the unit trusts, the ETF and the managed fund is not the taxable entity. The investor is a taxable entity, so that's why all the distributions and realized capital gains get passed through to you as an investor. Now, if we're looking at it from very, very, very top level, the only difference between managed funds and ETFs are the transaction mechanism. So with an ETF, of course, you do it through a broker, you do it through a service maybe like Rask Invest, or any which way you see fit, and you buy those units in the ETF on the market. With a managed fund, you fill out an application form, be it online or paper or whatever, send it off, and then send your, I was about to say send your check, but it's not 15, 20 years ago. You make your payment into the fund, and you get allocated your units. So essentially, but I guess the difference now in the terminology is a managed fund nowadays would imply an active strategy, And an ETF, like a bog standard ETF, I know the ASX have changed the rules on what you actually need to call them. So an ETF these days is deemed to be essentially a passive investment vehicle, either tracking an index, be it, say, the S&P 500 or the ASX 200 or ASX 300. But then you can also have ETFs that have a set of rules of their own making. And that could be like a factor ETF, where they might have 3 core rules that each set are used as a filter. And any stocks in Australia or the world that match those go into the ETF. Nowadays, though, you'll also see the term ASX product issuers put the term active ETF in front of it. Active ETF essentially means that it is essentially a managed fund that's listed on the stock exchange. So there's a fund manager behind the scenes buying and selling individual companies or whatever it may be that the ETF's investing in. But to delineate between the pure like passive ETFs and the ones with the active manager, you'll see that ASX actually put down active ETF in front of the name, or they can even have managed fund in brackets after the name as well. So that's essentially the difference between the two. So if you're seeing mutual funds, if you're seeing active ETFs, managed funds, etc., they're actually all just managed funds. It's the mechanism for investing in them, which is different.
Yeah, well said, mate. I like the point that you brought up about them being effectively the same legal entity. If we just took the F from that ETF and we made it the fund, that's where that comes from. Which is so it's basically the same thing, and the only thing that's different then is the E and the T, which is exchange traded, mean you buy it through your broker. But yeah, there's that legal kind of distinction, but then there's the implied meaning, which is most people now, when they refer to ETFs, they mean passive, as you said, and managed funds means active, because that's typically now the best way to do both of those things in their mind. So that's really fair. CEO's Travel, you did ask a question about JNDQ, Core or Satellite JNDQ, which is a relatively new ETF from BetaShares. Full disclosure, BetaShares is a long-term advertising partner of our Australian Finance podcast. I'm not paid to say that, obviously, but just for disclosure. So this next gen ETF effectively is targeting the companies outside of the top 100, which is really appealing to people because people believe that the top 100 is quite concentrated on those big tech stocks like Microsoft, Apple, Amazon, et cetera, et cetera. In terms of where it goes, I think it's a relatively new ETF, CEO's Travel. I think that we did an episode on it not too long ago with BetaShares, and there's a lot of these ETFs that come out and for different reasons. But for an ETF such as that, I think that probably something that investors could look at is maybe it's a satellite position. I would like to see how it goes for a little while longer before having a really strong view on it. And that's just simply because there are so many great options already. Not knocking the ETF. It's fine the way it's constructed, in my opinion. It's just we're holding off. And it's probably not the type of thing that we would have in our core portfolio, because typically our core portfolios are very broad and very boring. In fact, because the reason that they're boring, guys, is because we believe the value actually comes from the way you put them together, like the way you put ETFs together, not necessarily in the ETFs themselves. Like that's the easier question to answer, like which ETFs would make the list. It's how you put them together. And you can basically put me in a kitchen next to any chef and you will see the difference. And that's the analogy. I would be hopeless in the kitchen, but I could probably, pound for pound, I could probably, over the next 10 years, I think we'd probably do a better job than the average chef, no offense, who is an expert in making meals, we're making portfolios. And I think that's the key distinction. So this is something that's relatively new and comes from a great ETF provider, which is BetaShares. But we'll just keep this one either in the satellite or not at all for now, and then reassess it in the next year or two as it comes up. And that's typically what we like to do with the more targeted ETFs, like whether they're thematics or sector-based funds, is just kind of hold off and just wait to see how it plays out, because there's two mechanisms that are really important with that ETF. But one of them is, how do companies mature? And what I mean by that is, as a company matures out of say like a 100 to 200 or whatever, even in here in Australia, as a company matures, it obviously exits that ETF and then goes into the bigger brother. So then the company graduates and goes into the NASDAQ 100. That is a tax event for that ETF, which then gets passed back to the investors. But then also, if that company keeps on growing, obviously people have missed out on that growth. So what in effect it means is that you need to blend that ETF with another ETF. And so that graduation event dictates more than just the ETF itself. I hope I didn't lose anyone, but that's the general gist.
On the inverse as well, you've actually got businesses dropping out of the indices above, and on the decline as their market cap shrinks, going back through as well.
Yeah, and that offsets some of the gains. You're right, Mitch. But at the same time, one of the things that happens is, it's typically, if you think about a way a market cap weighted ETF is constructed, is typically when one of those, say the 99th position or the 100th position exits, proportionally to that ETF, that's a very small position of the ETF. So by that time, the taxable position from selling that is vastly different to the number one position at 101 going into the top 100 and then being downsized again.
Exactly.
Yeah. So I hope that that makes sense. That's why we tend to opt for really broad-based ETFs, but we don't go to the really broad-based ETFs like VGS, where it becomes more costly for an ETF provider to manage an entire portfolio of 1,500 securities, which is why I believe that an ETF like IVV will always be cheaper than the Vanguard VGS ETF. And I don't think there's that much benefit from having so many securities. I hope that makes sense. It's kind of like the sweet spot. Ahmed writes in and says, do you suggest to purchase even when an ETF's price is high? Ahmed, that's a good question. We're very, very long-term investors. I think it's fair to say, Mitch.
I think this question essentially goes back to what your own investment strategy is, Ahmed. Stock markets in general are always hitting all-time highs. They're always growing. There's more positive days than down days. If you sit back and actually take a look at your percentage chance of having a positive outcome from investing in, say, a broad-based indices like the S&P 500, if you look at that, there's studies done. You can Google, do a quick Google search, and it says, the chances of having a positive return after 1 year, 2 years, 5 years, 10 years. I think once you hit the 5-year mark, you're close to the 90% chance of having a positive return. So stock markets are always hitting all-time highs, especially when you're buying ETFs. But it absolutely depends on your strategy. Are you investing a lump sum, reinvesting the dividends and going to ride it out in a diversified portfolio? Or, of course, if you're doing a dollar cost averaging strategy, you want to set that, and you don't waver.
Looks like we may have lost Mitch, or maybe everyone's lost me. If you can let me know. Oh, no, we've got you back. Here we go. Got you back.
I don't know. I was just talking to myself for a couple of minutes.
We only lost you for a few seconds.
Okay, that's good. You stuff up a dollar cost averaging strategy by umming and ahhing and second guessing the markets and market movements, and holding off your contribution for that month or that quarter, whatever it may be. So, it's about getting a plan, sticking to it, rather than focusing on the prices of the ETFs.
Yeah, you make such a good point there, Mitch. And Ahmed, we'll show you what this looks like visually. Mitch and I normally refer to something like this. So we'll show you what this would look like. People are often scared about the stock market, being near an all-time high or something like that. Now, we don't have a crystal ball. The stock market could fall. The Australian stock market on average falls every 5 years.
Yeah, I reckon invest expecting it to.
Expect. Yeah. Andrew Page, who appeared on our Australian Investors podcast over the weekend, had this great line. He said, preparation, not prediction. And I think that's a really good turn of phrase. But if you look, Ahmed, and you look at any long-term stock market overall, if you look and you run your cursor from left to right, you'll notice that it goes from bottom left typically to top right. Now, in the case of Japan, that took a long time for it to come back, but you'll notice that it goes up, right? And the key thing is that most people are always fearful that the stock market's at a high. Why? Because it almost always is, to Mitch's point, like within 10%. It almost always is. And there are some bad years, and there are some bad years that are in a row, like 2 or 3 years. But this is why there's a phrase that's really, I love it. It's called the market climbs a wall of worry. If you just think about every time that the stock market reached a high, everyone would have been worried it's about to crash. Keep on going, keep on going, keep on going. And basically, my default assumption is that as long as the world's becoming a better place and capitalism still reigns supreme with democracy and all of those things, I think we'll be okay. And I think we'll still put money towards companies and people and entrepreneurs that solve the world's problems.
Yeah. I think for new investors and and existing investors, one of the best things to be aware of is to just Google the Vanguard index chart.
I can do that.
Oh, sorry, that wasn't a.
No, it's
good. wasn't a command.
Your wish is my command.
Hey Siri, Google. And just make yourself aware of this, because you can put, as you can see here, like you've got prime ministers, presidents, economic indicators, exchange rates, all that kind of stuff that you can overlay with this chart, because inevitably, as we get closer, especially say to November this year, you've got, a relatively large political event happening overseas. And inevitably there'll be headlines saying, oh, what's the stock market going to be like under Trump? Or what does Harris mean for the stock market? Blah, 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 blah. Just I'm going to save you time. They're absolute rubbish, those articles. So don't give them the clicks. If you don't want to see those headlines again, just don't give them the clicks. But you can go in here and you can use this tool to actually click on to overlay it with our presidents, and to see that, to be fair, over the long run, it's a non-event. So I think that's a wonderful chart to make yourself familiar with. And Vanguard even actually mail out those charts.
You can get a printed off version, stick it on your wall.
Hang it up in the bedroom. Nothing screams romance like a Vanguard index chart.
Yeah. You can pay gratitude to it every night before going to bed if you really want to. It actually would be a really fun exercise. It would make you a much better investor. Yeah. Justin said, what are your thoughts on VAS versus VAS and an SMSF? We have it in both, Justin. We have it in both of our portfolios, being Terra and Martian. The reason we designed Terra, which is our 50-50 strategy, the way that we did, is because we assumed that our community that invests in that, and you can read this in the Target Market Determination, or TMD, by the way. We assume that investors that go into that are interested in passive income, but they still want their money to grow. The key thing is that both VAS and VHY pay income. And the way that you can get to the bottom of will it grow is you can look at total returns. There's this, we had behavioral finance expert Simon Russell come on our podcast about a couple of years ago. Absolutely wonderful fellow and really insightful. And he said one of the great behavioral biases is that retirees think that they need a yield strategy when you don't. You can just sell the capital gains. Depending on the tax environment, it doesn't really make a difference. You
can definitely eat. I used to say you can eat growth as well.
Yeah, well, there you go. Exactly, yeah. And that's the beauty of using ETFs as well, because they're exchange traded. You can quickly exit, or you can liquidate part of the portfolio. You don't need to sell the whole property just to get a little bit of income out. And we talked a bit about property v shares in this, but ETFs are the vehicle to compare it to property because it's diversified, and it's the way it functions is kind of hands off as well, rather than stock picking individually, which is a little bit more required, a lot more hands on. Let's be honest. Just in the interest of time, Mitch, there was a question here from Tarwin. I didn't see this until now. I top up my core portfolio every 2 to 3 months and set aside funds for this dip. I just brought forward my purchasing. Oh, that was the reference to the sell-off.
Oh, yeah.
What do you think would happen to VHY's dividend yield if there was another GFC-like event? Theoretically, the IAF, ETF, and the VBND should provide a better yield in this theoretical macro environment. So he's basically asking if we see another really big stock market event, what would happen to dividend yielding ETFs versus bond ETFs?
Yeah, so with dividends from these ETFs, they're distributions. So they're dividends paid from the companies. themselves. So what you should take a look at, and maybe you don't have to go back through to the GFC to see this. Let's just pop back to the COVID correction, because a lot of these ETFs were active during the COVID correction. Not a lot of them were active during the GFC. So if you just pop back to the COVID correction, you'll be able to see, and I'm on the spot right now, but I believe the companies that made up these ETFs actually, dividends are cash flowing through these businesses. And so it's a great way to see the actual profitability of an individual company, to see the cash flowing through it and flowing out the other end to shareholders. And so during COVID, I know that a lot of those companies did cut their dividend. Cutting their dividend doesn't mean no more dividends whatsoever, but of course they have reduced profit, reduced cash, and so they paid a smaller dividend, which then results in a smaller distribution for both VAS, VHY, A200, IOZ, whichever way you get your ASX exposure, it would have resulted in a smaller dividend. But of course, they bounce back as they do, as the market recovered and as cash flows recovered.
Yeah, that's a great answer. And I'll add to that and just look at VHY as an ETF. So one of the reasons that I like VHY as a position in our portfolio is it finds about 70 to 75 different Aussie stocks that have forecast high dividends, not trailing dividends like some of those old cruddy dividend ETFs. Just used to be like, whatever was paid last year, buy that ETF, buy that share and put it in the ETF. Now they're much more sophisticated. In the case of VHY, it searches analyst database to say what companies are going to pay dividends in the future. So during a market crash type environment, the analyst would still be forecasting, right? That's the key thing. Now there is so basically what it means is you're not getting as many value traps. You'll still get some, but you won't get as many yield traps. People that go through their stock brokerage account and they go, here's a list of stocks. Let's pick the one that has the highest dividend yield. And they buy it. The stock keeps falling. And then the management team comes out and says, so yeah, things aren't good. We're cutting our dividend. So you've got a crappy stock and you get no income. And that's what we call a yield trap. Now, with an ETF like VHY, it does mitigate many of those risks in two ways. One, it's really well diversified, 70 stocks in one investment that you make in the ETF. And two, it uses forecast dividends. Now, in terms of the dividend exposure, typically dividend stocks will do better when a stock market is more volatile. The reason that they tend to do better is that the dividends tend to underwrite the performance of those companies. So this is not a guarantee, it's not a forecast, but it's more just like a rule of thumb that the industry uses, is that when things get a bit bumpy, typically the stocks that hold up best are the ones that pay good dividends. Why? Because they perceive it as safer. So typically they perform better than the growth stocks, which constantly do like this, like Nvidia earlier this month. And then the other part of Taiwan's question was more about bonds and about fixed income. Now, in a GFC style event, what would typically happen, this is typically speaking, it's not a guarantee, is politicians would freak out. They'd probably cut taxes as a first rule. Like they're probably like, well, let's give tax relief. Like the COVID, they were handing out checks. They were also thinking, how else can we stimulate the economy? But the second thing would happen is the central bank of that country, which is charged with responsibility of financial stability, they would look at the situation and go, things are pretty bad. We're going to need to cut interest rates. And so what would happen in that environment, like the GFC or like COVID, is interest rates would go boom, straight down, and interest rates would be cut. So mortgage holders don't get annihilated by still paying a high interest rate. They've got all of a sudden an extra $1,000 in their kitty every month. Even if they're unemployed, at least they're not paying as much back. So that's why interest rates function in the way that they do. So in that situation, what would happen to a bond ETF? It would go up in price because the bonds inside it that's already purchased are yielding whatever was paid yesterday. So even though the current interest rate has dropped, their bonds are worth more because the current interest rates are less than what they've already bought. So they go up. And that is true diversification. That is why we hold those ETFs. So for us, to Tarwin's question, it's not necessarily how would they, which one should I choose? It's we'd have both. And you can see now why we have both in there acting the way that they do side by side, and we build a diversified portfolio. I hope that all makes sense. Rant over.
There's to go back to your. I read an article recently, and I had heard about this for quite some time. There is a theory that the dividend-paying stocks, your traditional Telstras, your Woolworths, et cetera, are of course much high quality businesses, and they're more the management teams are better managers or allocators of capital because they have to they're a lot more disciplined with that capital, and they actually, generally speaking, tend to outperform over the long term. So
yeah, that's a good point. One of the things that Tarwin's just followed up and said COVID was a V-shaped recovery, which, we admit that. But I was more referring to the GFC, which is when all of those things that I mentioned played out. That was the worst crash in stock market history for any single year. You could go back to the Great Depression era. That was a worse overall stock market environment for about 5 or 10 years. But in terms of a single big event, GFC is the worst in history. And so that's all reasonable. But to your point, Mitch, like one of the things that we are paid to do is we're not just looking at like cyclical bank stocks and mining stocks that are at the top of the market. We have to then be reasonable and understand what components of an ETF, of the stock market as a whole, enable our investors to get income from their investments. And at the moment, the biggest contributors to your paycheck through an ETF, CommBank, BHP, Rio, Fortescue, NAB, Westpac, even CSL, even though the yield isn't high, it's such a big part of ETFs that it's a big part of the dividend that you ultimately receive. And so we have to look at that. And then we have to say, does that sound reasonable for the next 10 years? And that's why we then start to talk about maybe we should be pushing some of the portfolio into a different asset class, or maybe we should, instead of using bank shares, maybe we use bank hybrids, or maybe instead of blue chip shares, maybe we blend in a little bit more of those medium-sized companies or the small cap companies, or all of these different questions. And at the moment, we've got a very good happy underwriting, which is from Cash. Cash is providing us this wonderful, consistent income stream. Our AAA ETF pays our investors every month into their cash account, and then we can keep investing. So, yeah, that's how it all comes together. So, Tarwin, more than happy to help, mate, and same with you, Troy. But, mate, we can see some questions here from Ankit as well. What we would love you to do, just in the interest of time, is jump over into the Rask community. I'll just show you what that looks like for everyone that hasn't already been in there. It's free. You can join anytime you like. I'll just pop it in the chat. It's free. You can see, like, we get some absolutely wonderful questions every single day. As well,
I really like that AI question. Not question, the AI topic where old mate here has jumped in and asked his the Facebook AI service, chatbot, whatever it is, for a recommendation on an ETF portfolio. I must say, we were chatting before. I've seen a lot worse portfolios put together than this one.
Definitely,
yeah.
I was a bit concerned about the overlap.
Yeah, there's a little bit of overlap.
There'll be some substantial brokerage fees incurred in this portfolio, but anyway, everyone, you can jump over there into the Rask community. It's totally free. If you've already got a Rask account, you just basically select login with Rask, or you create your account. It's free. We love to hear from you. So we do this every month. We've obviously got the live shows, the podcasts, the courses. We're almost at 30,000 enrolled students in our free courses. So we should hit 30,000 enrolled probably about this time next month. So by the time we do the next one of these, we should be able to break out the confetti and do a bit of a song and dance, and be really happy with that. So thank you to everyone that supports us by investing with us, by just coming along to our events, by being part of Rask Core, by listening to our podcast, which we put advertising on. That's how we make that happen. So thank you so much. You can invest with us at invest.rask.com.au, which is where you'll find the PDS. Mitchell's email is there. But the best thing to do, if you want to invest, you can just head straight to the website, or there's the book a call link, which is available on YouTube.
I've just added the book a call. That's to speak with me to the chat there as well. I've come up as host. So there's my Calendly link. And love to have a chat with anyone and everyone.
Yeah. So thank you everyone that has invested with us already and supported us through this journey. Just a special bit of housekeeping before you go. You guys will be the first ones to know this. Over the next 4 to 6 weeks, Rask is getting a massive facelift. So we're going to get new jumpers, Mitch.
That's good because from down here, I've actually got a couple of marks. So I need a new jumper.
A few too many lunches. You and me both, mate. I think I bought about 10 of these, and I think this is one of 2 left. So we love to hear from you. Expect some really good changes to come to Rask over the next few months, and thank you for your support. So thanks for everyone.
If you want to be involved in providing us with feedback on our upcoming brand refresh, jump on the Rask community because there's a post there looking for volunteers. So if you do want to be involved in giving our lovely designer Sophie some feedback on what she's working on, then that's the place to put your hand up at.
Yeah, jump in the community and let us know because we do really appreciate the feedback, especially on things like design. We got some funky designs coming down from the pike. So let us know. And bye for now. Thank you. And if you're going to tune in Thursday for Rask Invest Live, I'll see you then. And Mitch, thanks for joining me, mate.